50% of UK population are investing in the stock market, although over 70% believe that it could be quite profitable to invest in the market over the long term. The reason why a lot of people are not investing is because they still believe in some of these myths and misconceptions about money and investing. Let's get started. Number one, investing is just like gambling. Well, wrong. Investing is nothing like gambling. Well, of course, it comes with some sort of investment risk, which is why it always says this abrupt line: you may not get back what you invested. But that is why it's called a risk, because there is no such thing as having a free lunch. You have to appreciate the fact that what goes up can also come down. But the idea is time generally smooths out these short-term volatilities. So if you do a line of best fit over time, it is expected to trend up. But when you are gambling your money through games or even buying a lottery, you're pretty much relying on your own luck and some probability. And the odds of winning are not very good. But unlike gambling, when you are investing in the stock market, you are not simply throwing your money at random odds, but in real businesses. So as businesses prosper, so does your bank account. Here's a piece of statistics for you. Since 1926, US stock market returned a positive rolling 5 years return 87.5 times and only a negative return 12.5 times. And if you are a long-term investor who is willing to invest for say 20 years, then the percentage of positive return increases to 100%. And the great thing with investing is that it can actually accommodate for people with various risk background and risk appetite. So for example, you may have noticed that when you buy a fund or an index fund or an active fund, it usually comes with a risk rating between 1 and 6, 6 being the highest. So you can basically pick and choose something that actually suits you. But here's the funny part: if you don't invest at all, you're actually taking a guaranteed loss with your money. And that is in fact a big risk itself. Why? Because of inflation. Let's say, for example, you were a proud owner of $1 back in 1900 and lived until 2020. Then that $1 would be worth only 3 cents today. But if you had put that dollar in some sort of investment, such as stock market, then it would be worth $64,650, probably enough to cover your health costs for living so long. Myth number 2, investing is only for the rich. I'm not saying this, but according to a survey, 58% of British folks believes in this myth. But no, this is a very rich lie. If you're someone who earns and saves, then you can also invest. Money left in your bank account is simply dying of boredom. But here is the exciting news: it is free to actually put that money to work. All you have to do is open a brokerage account, which is generally free to open, and you can start with as little as £100. And in terms of cost, how this actually works is that, say you put £100 into that brokerage account, they will not start charging you any money because you're still holding that money as cash. But say you invest that money in the stock market by investing it in a fund, like an index fund, then over time, every year, the brokerage firm will start charging you some sort of money, say 0.15% from the overall value of that money that you have invested. So if your pot of £100 doubles and becomes 200, then they will charge you 0.15% from that £200. And of course, if you are investing in funds, they will also charge you some fund management fee, which is also very little if it comes to those index funds. And if you want to join the rest of us, become a long-term investor, you can set up a monthly reoccurring investing rule with at least, I think the minimum commitment you need to make is about £25 a month. So if you can automate your investment, so every month they take that money from your bank account and put them into the fund of your choice. So you can do that. It's not very much. £25, it's how much? It's like 6 latte or 6 coffee from Starbucks or like 9 Happy Meals from McDonald's. Don't ask me how I know that. But yeah, it's not very much. But over time, that little amount of money, you can start to increase that amount from £25 to £50 to 100, 500, depending on your salary. And over time, they should add up to a very big, healthy amount. Myth number 3, your money will be locked away and you cannot access it. Wrong. Your money is readily available. You can sell your investment anytime you like. But I understand why a lot of people may feel that way, because when we do talk about investing, we always say that you have to do it for the long term and you must, put the amount of money in big investment if you don't need that money for the next 5 years. So you have to commit for at least 5 years. But the reason why we say that is nothing to do with the fact you cannot take that money back, but it's a really good risk management practice, and it also helps you to sort of anchor your own expectation. So in practical terms, think about a time when you actually have a lot of your money invested in the stock market and you don't have any cash savings in your bank account, and suddenly you have this big payment that you have to make, and at that time the only thing you can do is sell out of your investment. But imagine the stock market is also down that time, say it was during COVID or a GFC, like a stock market crash, then you will be forced to sell your investments at a loss, and you don't want to do that, right? Which is why we say at least keep 3 to 6 months of your living expenses in a cash account, so at least some sort of savings account that gives you a high yielding return and not just under your bed. And the money that you don't need for at least the next 5 years, put that to work by investing them in the stock market. Number 4, you need to know what you're doing. Nah, not really. A lot of people don't know what they're doing, especially when it comes to investing, if I'm being completely honest. But the beauty of investing as a long-term investor is that you don't have to be an expert in this subject. We cannot possibly know everything about everything, but knowing a little bit of something will do just fine. So here's a small list of things I suggest you try to understand a little about so that you can get started with investing. Number 1, understand a little bit about what is the stock market. So the basic knowledge about the market and stocks. Number 2, know the difference between funds and ETF. Number 3, learn how and with who to open an account with. Number 4, which is optional, and that is to know how to pick a fund to invest in. And number 5, which is also optional, and that is to know how to build an investment portfolio. Myth number 5, it is time consuming. I mean, I get it. A lot of people are just not bothered to spend time learning about the stock market and stocks and what's happening in the financial world. We don't want to spend our free time reading about what's happening with inflation, what the Fed is doing with interest rates, or why on earth UK can't get over Brexit, or even what Elon Musk tweeted which sent Tesla crashing. It's true. It feels hectic and borderline frightening. But the good news is you don't have to bother about these things at all. You don't have to love these topics or even be interested. Remember, you're not investing because it's a hobby. You are investing so that you have enough money over time so that you can spend more on your hobbies. All you need is the right mindset, patience, and some money to put into a low-cost index fund. The best thing to do as a long-term investor is to completely ignore the noise, like block it out, and invest consistently. Picking winners is a real tough job. Even the experts can't do it all the time. So why even bother? Just buy all the stocks there is with an index fund. And with winners cancelling out the laggards, you should get some healthy expected return over time. In terms of time commitments, I'd say twice a year is about right. That should be fine. You don't even have to log into your investment account on a monthly basis. The best thing to do is set up an automated direct debit with your brokerage account so that every month they take a certain amount of money from your account, automatically put them into the stock market in a low-cost index fund so that you don't even have to do it yourself. And twice a year, just look at the performance of your investment portfolio. See where you are against your goals and how your funds are performing. And if you want to, you can read up on different funds and change your allocation even if needed. Number 6, you have to know when to buy. No, again, a big no. No one can time the market. If someone tells you they can, run for your life. Trying to time the market is one of the worst things you can do with your money. Yes, looking at historical returns of GFC and 2020 COVID recession, you may wish that you sold just before the crash and bought right at the crash. Ideally, that would be perfect, but unfortunately, that is not achievable. Research showed that an investor's odds of perfectly timing the market just 50% of the time were 0.5 raised to the power of 816. In other words, virtually 0. So it is not expected of you, so don't even bother doing it. And finally, investing is a get-rich-quick scheme. No, it's far, I mean like really far from it. It is just so far away that you may even be disappointed if I tell you to expect a return between 5 to 10% every year. But the magic of investing and the reason why it is a wealth building mechanism is not because of the number of expected return that it is quoted, but because of time. Thanks to the power of compounding. Here is the fact: the market rewards long-term investor. What is required is not passion, but a cool, calm head and the discipline and the patience to leave your investments to grow. If you're someone who gets impatient and you expect to get a return of 20% year after year, then investing in the stock market is not for you. Or if you're someone who gets scared really easily and you think you will panic sell all your investments every time the stock market crashes, then investing in the stock market just won't do any justice to your money. For example, say you have £100 portfolio where 60% of it was invested in stocks and 40% in bonds. And during the market crash of GFC, so in 2008, your portfolio plummeted by 34%. At that very point, if you panicked and decided to move all your money to a cash savings account, then you'd have a cumulative return of only 6%. If you, however, left your money in your stock and bond portfolio, then even after the crash, it would have returned you 206%. So to be honest, you would actually want to invest in a boring yet stable stock market, which won't win or lose you 50% a year every now and then, but provide you with a stable and consistent positive return over the long term. So ultimately, do remember that it's got a lot to do with probability. For example, if an investment is offering you a 1000% upside, but with only 0.01% probability of that happening, then your expected return for that upside will be 0.10%. But if a boring stock market is offering you a 8% return with probability of say 60%, I just made a very loose observation looking at how many times S&P 500 returned above 8% since 1950. Then your expected return becomes 4.8%. A lot better, right? Also pretty clever. Well, I hope this video helped clear out some of the myths about investing. Don't forget to like and subscribe to my channel if you haven't done so already. But that is all for today, and until next time, look after yourself and your money.